Hello, this is Ian, Henry of AutoAnalysis, working with the latest production outlook briefing from the SMMT. The first thing to say this time is that it is now clear that there is major structural change taking place amongst the European vehicle manufacturers. Many of them are loss-making and they are facing long-run structural decline, especially at Fiat, Ford, General Motors, Peugeot, Citroën and Renault. This restructuring has involved Ford, GM and PSA already announcing plant closures, Ford at Genk and Southampton, GM at Bochum, PSA at Aulnay, while Fiat and Renault are reorganising their production allocation between their Italian and their French plants, although we still think it is likely that Fiat and Renault will need to cut capacity, i.e. close factories in the long run. So what are the highlights of the latest production outlook? Well, the first thing to say is that 2012 will not actually be a very good year for European production. Including Russia, European production falls by around 600,000 units. Excluding Russia, it falls by around 1 million units. And a complete collapse of production across Europe has only been prevented by continued growth in the Czech Republic, Hungary, Romania, Slovakia and the UK. The big losers in 2012 are Spain, Italy, France and Germany, although we think the fall in Germany is largely a short-term effect due to the decline of Ford and Opel and some model cycle effects. By 2016, Germany should recover to be up on its 2007 volumes, but in the long term, France, Italy and Spain will all decline, France by 30%, Italy by slightly more and Spain by 20%. And this is reflected in the eastward shift of production elsewhere, with the Czech Republic, Hungary, Romania and Slovakia all growing strongly. If we look at the figures graphically, as on this chart, we see that total European production, including Russia, this year will be around about 19 million. It will fall next year to around 18.5 million, a slight recovery next year to 19 million, and so on. And including Russia, it does look as if the market recovers well from 2014. However, the reality, without Russia, is somewhat different. As we say, without Russia, the picture is somewhat less attractive, and this is shown on the following chart. Without Russia, and still being optimistic, we think that Europe will take until 2016 to recover to its 2007 volume. That's shown in the base outlook, which is the blue line. We've run 3 alternative scenarios which assume falls in the major markets of between 1 and 5% above and beyond the falls inherent in our base outlook. And this produces slightly smaller totals in the end, but still we see the market in these scenarios recovering to not that far off the number in our base outlook. However, things could turn out to be much worse, very much worse in fact. At the moment, Europe is on course to be down by about 7% in terms of sales this year, and it could be even worse than that when the full year figures come in. And if things continue downwards next year, we would expect production also to continue to fall. This becomes apparent on this chart. The blue line is the base outlook, including Russia. The pink line is the base outlook without Russia. So the first thing that we see there is the widening gap between the without and with Russia production numbers. In other words, Russia is taking up an increasing proportion of European production. We have 3 worst-case scenarios. First of all, the yellow line has European production next year being not that much different to this year, and it will recover but at a slower pace. But the worst-case scenarios really look at what happens if 2013 and 2014 continue to decline, which is something that we think is actually increasingly likely. The implication of that is that if we have even a similar rate of recovery as in the base outlook, Europe will not recover to anything like its past glories in terms of production volumes. In fact, by 2016, it's quite conceivable that European production volumes could be only just above 17 million. And we have to ask the question, if long run the European production, excluding Russia, is 17 million or worse, is the current industry structure sustainable? In other words, can all the car companies survive? It's clear that things have indeed changed, but many questions remain. The car companies are no longer just talking about restructuring, they have had to act and are acting. Why have they had to act? Well, GM and Ford are going to lose over €1 billion each in Europe this year, and Renault, PSA and Fiat are also loss-making in Europe. So will the closures they have announced so far be enough? And can Fiat and Renault avoid closing factories? Will Ford, GM and PSA actually have to close more plants? On balance, we think they will have to, and we certainly think it is doubtful that exports beyond Europe will be able to sustain European production volumes, particularly when you look at the growth by Volkswagen, Fiat, PSA, BMW and Mercedes, for example, all of whom are growing their plants outside of Europe, especially in North America, Brazil and China. So in conclusion, we think any recovery in production is unlikely before 2014, and any recovery will itself be much shallower and slower than we'd previously thought. We also think it is highly likely that long-run production volumes in Europe will be far below the 2007-2008 peaks. We think that further restructuring and capacity cutbacks are inevitable, although the timing and the effective plants are somewhat unknown at this stage. We also think there's a realistic chance of a major European name disappearing. And alongside this, we need to recognise the rising strength of the Koreans and the enduring appeal of the German premium brands. It's not a question of if or when the European vehicle manufacturers will restructure. The issue now is how much more change will be required. And we also have to say we don't think that national governments, particularly those in France, Italy and Spain, will be able to save their national brands. Thank you for listening. Until next time, I would like to take this opportunity of wishing you a happy Christmas and a prosperous new year, especially in the current economic circumstances. Details of how to access the full report are now shown on the screen. Goodbye.